when you board a commercial flight, right, you settle into your seat and you hear the captain's voice over the intercom. You're basically trusting this sprawling, totally invisible infrastructure.
Yeah, I mean, you see the airplane, sure,
Right.
and you see the flight attendants, but you definitely don't see the global ecosystem that actually taught those pilots how to handle, a crosswind landing or a sudden engine failure.
Exactly. Welcome to the Deep Dive. We are super thrilled to have you with us today as we explore this really fascinating corporate pivot that's happening entirely behind the scenes of global aviation.
It's an incredible story, honestly.
It really is. So, okay, let's unpack this. Today, we are looking at the fiscal year 2026 earnings report and this really aggressive, sweeping transformation plan from a company called CAE.
Right, and it is just a phenomenal case study in corporate survival and adaptation. I mean, CAE is a nearly 80-year-old titan.
Yeah, they've been around forever.
Exactly. They operate in over 40 countries, building those colossal room-sized full flight simulators and, running the training programs for commercial airlines and defense forces worldwide.
Not even master.
It is. What's fascinating here is that the earnings report we are diving into isn't just a dry ledger of their $4.9 billion in full-year revenue.
Right, not just spreadsheets.
No, not at all. Under the leadership of CEO Matthew Bromberg, this document is, well, it's a live blueprint for a radical cultural and operational overhaul.
Yeah.
It shows us in real time how an industry giant reacts when it collides with soft commercial markets and severe geopolitical volatility.
So our mission today is to decode that blueprint. We're going to explore how a global training company is literally rewiring its physical footprint and fundamentally changing its financial accounting to survive and hopefully thrive by fiscal 2030.
That's the goal.
Right. But to understand the transformation, we have to establish the baseline. We need to look at the financial realities that are forcing their hand. Looking at the snapshot of fiscal year 2026, it is a stark tale of two entirely different sectors, just pulling the company in opposite directions.
The contrast is striking. I mean, on the surface, total revenue for FY26 hit $4.9 billion, which is a 4% increase from the previous year.
Which sounds great, right?
Yeah, that top-line number sounds perfectly healthy. But beneath that surface, there is this sharp fracture between their two main businesses.
Right.
The civil aviation side and the defense and security side.
Let's look at the civil aviation side first, since it's their biggest segment. Revenue there was $2.74 billion, up only 1%. But the operating income is where the flashing red lights appear.
Oh, definitely.
I mean, in the fourth quarter alone, civil operating income plummeted to $88 million compared to $197.4 million in the same quarter last year.
It is a severe margin squeeze. Now, you flip the coin to defense and security, and that sector's annual revenue grew 9% to $2.17 billion.
Wow.
Yeah, their operating income went up significantly, and they booked an astonishing $2.4 billion in orders for the year.
That's wild.
It is. Defense is being fueled by new partnerships with major original equipment manufacturers, the OEMs, and a soaring demand for what the report calls sovereign capabilities.
Wait, before we move into the mechanics of the civil side, what exactly do they mean by sovereign capabilities? Are we talking about, like, allied nations demanding their own private, localized servers for simulator training instead of sharing a global network?
That is a big piece of it, yes. In a really tense geopolitical climate, allied nations are prioritizing absolute self-reliance.
Makes sense.
Right. They do not want their sensitive military training data flowing across international borders, and they want physical assets located within their own borders, maintained by their own citizens with specific security clearances.
So they're pulling it all in-house, basically.
Exactly. Sovereign capability means nationalizing the training infrastructure. They want integrated mission rehearsals tailored to their specific classified defense strategies, and, well, they're willing to pay a premium to build those isolated ecosystems.
And that investment directly translates to CAE's bottom line.
Absolutely.
So that makes the defense boom perfectly logical. But I want to go back to the civil aviation slump for a second.
Here.
Because the source material notes their civil training center utilization hovered at about 70% for the year, and they delivered 52 full-flight simulators. I'm trying to connect the dots here between the airplane factory and the simulator bay. It's kind of like a massive university, right?
How so?
Well, imagine a university where the liberal arts enrollment is suddenly flatlining, but the engineering department is just bursting at the seams.
That's a good way to look at it.
The report cites supply chain constraints limiting aircraft deliveries. But if airlines are still flying packed schedules today with their existing fleets, why does a delayed delivery from Boeing or Airbus hurt training demand right now?
That's a great question, and it really comes down to how pilot certification actually works.
Okay.
Pilots don't just hold a generic license to fly, they hold what are called type ratings for a specific aircraft.
Right.
So a pilot certified on a Boeing 737 cannot legally jump into an Airbus A350 without undergoing extensive simulator training for that specific airframe.
Oh, got it. So the timeline of the training has to completely match the delivery of the physical airplane.
Completely. Airlines do not want to spend, say, $50,000 putting a pilot through a specialized 777 training program today if that new 777 won't actually be delivered for another 18 months.
Because they'd just forget it.
Well, more because of strict regulatory windows.
Mm.
The pilot certification could actually expire before they ever sit in the real cockpit.
Oh, wow.
Yeah, so when supply chain issues force aircraft manufacturers to delay deliveries, the airlines immediately hit the brakes on simulator training for those new planes.
The bottleneck at the factory floor creates this instant bottleneck at the training center.
Yeah.
That is a brilliant illustration of how pilot training acts as a leading indicator for the health of the broader aviation industry.
It really is.
So CAE is caught in a supply chain crossfire they have absolutely no control over.
And that lack of control brings us to the broader map, right? This split in performance where civil is struggling while defense surges is inherently tied to global instability.
Right.
The earnings report highlights the ongoing conflict in the Middle East as a primary disruptive force here.
And it's not just a theoretical risk for them. The sources detail how the conflict is having a real month-by-month operational impact.
Definitely.
Airspace closures and shifted flight routes force airlines to constantly change their operations. For CAE, this means they are actively having to redeploy certain training activities within their global network just to keep things moving.
It creates a massive logistical puzzle. You have instructors, pilots, and open simulator slots. But the actual airspace volatility prevents people from traveling to certain hubs.
Oh.
Or it forces airlines to suddenly change which aircraft they are flying on rerouted paths. And that necessitates entirely different training regimens on short notice.
Here's where it gets really interesting, though. Looking at their fiscal 2027 outlook, CAE is building their baseline financial assumptions on the idea that the Middle East conflict will, and I quote, wind down in the first half of our fiscal year.
Yeah, that's a bold claim.
I have to push back on that. Isn't it incredibly risky for a global corporation to base its near-term financial outlook on predicting the timeline of a highly complex, deeply entrenched geopolitical conflict?
This raises an important question about corporate forecasting. I mean, management teams are required to provide investors with a baseline scenario.
Right, they have to give them something.
Exactly. But the report itself is heavily padded with caveats acknowledging that exact risk. They openly admit that if the conflict worsens or expands to impact global oil markets, the cascading effects would be severe.
I imagine fuel prices are the ultimate domino there.
Without a doubt. If regional tensions lead to sustained fuel price spikes, airline profitability takes an immediate hit.
Right.
When airlines hurt financially, they pull back on capacity expansion and new hiring, and that instantly suppresses training demand.
Making everything worse.
Exactly. Add in the potential for broader supply chain disruptions, cutting off spare parts for the simulators themselves, and CAE's projections could just crumble.
So they're basically hemorrhaging cash on underutilized commercial simulators because of supply chain delays, and their recovery timeline is heavily reliant on a volatile geopolitical situation they cannot influence.
That's the reality.
If you cannot fix the world, you have to fix your own house. How do you surgically shrink a global company to survive that?
You target the only things you can control, your own floor space and your operating leverage.
Okay.
That is the core of their transformation plan. It is a multi-year physical restructuring aimed at delivering $125 million to $150 million in annual run rate savings by fiscal 2030.
That's a huge number.
It is. To achieve this, they are removing 10% of their commercial full-flight simulator fleet entirely and relocating or optimizing more than a dozen others to drastically reduce their real estate footprint.
I think we need to visualize the scale of what that means, right? Because these aren't desktop computers.
Oh, no.
These simulators are multi-million-dollar, room-sized hydraulic beasts that literally recreate the exact physics of flight. Moving one across a continent is an engineering feat.
It really is.
Removing 10% of a global fleet is a monumental shift in strategy. It feels kind of like a global gym chain. looking at its metrics and deciding to unbolt and scrap 10% of its treadmills, permanently closing specific locations.
Yes.
You are actively choosing to accept a smaller overall capacity, making a calculated bet that you'll achieve much higher profit margins on the remaining machines.
The gym analogy perfectly captures the financial mechanism at play here. It is all about utilization rates and fixed costs.
Oh.
A commercial flight simulator costs roughly the same amount in real estate leasing, maintenance staffing, and climate control, whether it is running for 4 hours a day or 20 hours a day.
Because it's just sitting in the room either way.
Right. By shrinking the denominator, removing the 10% of treadmills that are only used occasionally, you force the remaining traffic onto a smaller number of machines.
Right.
So
Yeah.
your fixed costs plummet, and the profit margin on every hour sold on the remaining simulators skyrockets.
But ripping out those metaphorical treadmills requires a lot of upfront capital. The source material outlines the financial sting required to achieve this leaner future. The total anticipated cost of this transformation is between $200 million and $250 million.
Yeah, it is a heavy, painful lift. Out of that total, about $100 million comes from non-cash charges, such as, writing down the book value of the simulators they are retiring.
Right.
But the remainder is real cash spent on severance, lease breaking, and the physical logistics of relocating these massive assets. They spent $84 million on this in fiscal 2026, and the majority of the balance will hit in fiscal 2027. The report actually refers to fiscal 2027 as an execution year filled with what they call temporary cost inefficiencies.
Which is corporate speak for it's going to hurt. You have to endure an incredible amount of disruption to unbolt these machines, put them on cargo ships, and rewire your global network.
Definitely.
And as they physically restructure the company, they are also fundamentally changing how they keep score. They are updating their financial metrics to align executive incentives with long-term shareholder value.
This accounting shift is a critical piece of the transformation. Starting in fiscal 2027, they are altering how they calculate adjusted segment operating income, adjusted net income, and adjusted earnings per share.
Okay.
The most significant change is that they are now excluding the amortization of acquired intangible assets. In fiscal 2026, that specific amortization expense cost them $86 million on paper.
So what does this all mean? When a company announces an aggressive transformation and simultaneously changes how they calculate their own profits, my internal alarm bells go off.
I get that.
It's really easy to be cynical and wonder if they are simply moving the goalposts to hide a bad quarter. To understand if there is a legitimate structural strategy here, we need to translate that jargon. What exactly is an acquired intangible asset, and why does amortizing it obscure the actual health of the business?
It is a vital distinction to make. An intangible asset is something a company buys that holds value but doesn't have a physical form. Think patents, brand recognition, or, proprietary software.
Okay.
When CAE acquires another company, they put a dollar value on those intangibles. Accounting rules dictate that this value must be slowly reduced or amortized over time as a business expense on the income statement.
So it looks like a loss.
Exactly. However, that amortization does not represent cash actually leaving CAE's bank account today. It is a paper loss.
Okay, I like to think of this like a household budget. Imagine calculating how much cash you have available this month to buy groceries and pay your utility bill, but you insist on subtracting the theoretical depreciation of your home's foundation from your checking account balance.
That's a great example.
It makes your monthly budget look way worse than your actual cash reality.
That is a highly effective way to frame it. If we connect this to the bigger picture, by excluding that non-cash amortization expense from their adjusted operating metrics, management argues they are providing a clearer view of the actual cash-generating power of the core business.
That makes the shift sound less like moving the goalposts and more like, cleaning the lens.
Right.
And they're making another major adjustment regarding free cash flow, right?
Yes, they are. They are revising their definition of free cash flow to include all capital expenditures and all capitalized development costs.
Which means what?
Well, historically, some companies might try to exclude certain heavy investments from their free cash flow calculations to make the metric look more appealing. By rolling everything into the calculation, CAE is enforcing strict transparency on how they spend money.
It forces total discipline. If you want to build a shiny new training center to capture a localized market, you can't hide the cost. It hits the primary free cash flow metric immediately.
It ties directly into their new strategic focus on return on invested capital, or ROIC. By evaluating executives based on ROIC, the board is fundamentally changing the incentive structure. They are punishing growth for the sake of growth.
I want to make sure we underline why ROIC is such a powerful lever. You could theoretically grow a company's revenue by taking out a massive loan to build a $50 million facility.
Exactly.
The top-line revenue goes up, which looks great on a press release. But if that new facility only returns $1 million a year in profit, you are actually destroying value because the return on the capital you invested is abysmal. ROIC forces a company to only build or expand if the return clears a specific, highly profitable hurdle rate.
You nailed it. It prevents empire building. This comprehensive accounting overhaul is designed to enforce a relentless cash-centric focus. They are targeting a 100% cash conversion rate over the 4-year period ending in 2030.
Which means
That means for every dollar of adjusted net income they claim on the income statement, they are demanding an actual physical dollar of free cash flow in the bank.
and they are aiming high with these new metrics. They're targeting $950 million to $1 billion in adjusted segment operating income by fiscal 2030. What stands out to me in the sources is their explicit statement that over half of this improvement must come from internally driven initiatives within their control.
Right.
They are refusing to just cross their fingers and hope the commercial airline market magically recovers.
They are taking ownership of their own margins. The baseline assumption is that commercial volume will eventually grow, but the true journey to that $1 billion mark has to come from the transformation actions they are taking today.
The painful stuff.
Yes. Removing the underperforming simulators, optimizing the network density, and enforcing strict capital discipline.
So, synthesizing this journey we have been on today, CAE is navigating an incredibly complex global map. Defense spending is surging as nations scramble to protect their sovereign capabilities and nationalize their training.
Yeah.
Meanwhile, commercial aviation training is bogged down by supply chain issues holding back aircraft deliveries and global conflicts that reroute fleets overnight. Their answer to this paradox is a painful but necessary multi-year surgery.
A massive shift.
It will cost them up to $250 million now to shrink their physical commercial footprint, rewrite their financial metrics to prioritize cold, hard cash, and emerge in 2030 as a leaner, highly profitable machine.
It is an architecture built for resilience. They are prioritizing cash generation and disciplined capital allocation over sheer, unbridled market footprint.
Why does this matter to you? Well, the next time you board a commercial flight, take a moment to realize that the complex, invisible ecosystem keeping those pilots expertly trained is currently undergoing a ruthless optimization behind the scenes.
It's true.
It is a powerful reminder that even the most established global leaders cannot simply ride out a storm. They have to actively adapt their anatomy or face the consequences.
I will leave you with this final thought to mull over. We are watching a nearly 80-year-old global leader in aviation safety actively choose to shrink its commercial training capacity while simultaneously doubling down on highly specialized sovereign defense capabilities.
Yeah.
What does that corporate action signal about the macro trends of the next decade? Are we quietly crossing the threshold into an era where national security and defense spending will definitively outpace the growth and perhaps even the globalization of commercial air travel?
It is a profound question, and one that extends far beyond a single earnings report. Thanks for joining us on this deep dive.